Welcome back, and today we're going to cover Chapter 8, Section 2, which is going to be income tax. And so this is going to be an important topic that you're going to want to make sure you pay attention to. There's a lot of moving pieces here, and you're going to want to make sure you keep things straight. Okay, so again, make sure you watch this video before class and practice, practice, practice with the other examples, the examples that I go over, and also with the suggested homework as well. So we're going to learn how to determine gross income, adjustable gross income, and taxable income, calculate federal income tax, calculate FICA taxes, and solve problems involving working students and taxes. So now income tax is a percentage of your income collected by the government to fund its services and programs. So now calculating income tax, first thing you need to do is you need to determine your adjusted gross income. Now your adjusted gross income is going to be equal to your gross income. So that's everything you make before taxes. So this is all the income for the year, including wages, tips, earnings from investments, and unemployment compensation. And then you're going to subtract off any adjustments. And what are adjustments? Those are tax deferred savings plans. Okay, so if you invest in your company 401k, then you would not include that as that would be subtracted from your gross income. If you invest in any other qualified plan, what they call a qualified plan, so that would be as far as what else would be, so 401k would be an example of an adjustment. IRAs may be that, but usually IRAs are after taxes. So, but these are what we're going to call the adjustments, and we're not going to be getting too complicated with this. Okay. Now, after you've determined the adjusted gross income, then you're going to determine your taxable income. This is the income that you'll actually be taxed on. So you take your adjusted gross income, and then what you're going to do is you're going to subtract off any and all exemptions, and you're going to subtract off any and all deductions. So what is an exemption? Well, it's a fixed amount for yourself. Okay, so an exemption is going to be based on an amount based on your dependents. Okay, so a fixed amount for yourself and the same amount for each dependent. Okay, so in 2005 is $3,200. Okay, now for deductions, this is going to include either a standard deduction or an itemized deduction. Most people take the standard deduction unless you own like a home business or something like that. Then you may do the itemized, but for the majority of people out there, they take a standard deduction, but it depends. Whichever one turns out to be the greatest of those two, okay? Usually you take into consideration both, and then whichever one's the larger amount is the one you take, okay? Which makes sense, right? Now this includes interest that you may have paid on a home mortgage, state income taxes, property taxes, charitable contributions if you've given to charity, donated items to like the Salvation Army, to your church or what have you, and any medical expenses that exceed 7.5% of your adjusted gross income, this amount. Okay, so anything below that, anything equal to and below 7.5% is not included, but any amount over that 7.5% of your adjusted gross income is deductible. Okay. Now, 3, once you've determined your taxable income, then what you do is you figure out what your income tax is. Now, there's 2 parts to this calculation. You have to figure out what your tax computation is. This is using a chart. Okay, so use the taxable income that you calculated in the last step and the tax rates for your filing status, either single, married, or etc. Divorced, widowed, head of household, those sorts of things to determine this amount. So this is determined by your filing status and the amount of income that you have for your taxable income. Then you may have tax credits. So this may include up to $1,000 per child. So if you have children, and the cost of the child care if you paid for child care that year, so the parent can work, or an adoption if you adopted a child. Those you get credits for that as well for qualified expenses. Okay, and so those are deducted from that taxable computation. And then the net amount is your income tax that you will have to pay. And if that turns out to be negative, then you end up with a refund. Okay, so now, gross income, adjusted gross income and taxable income. So let's look at this. So we have a single man earned $46,500, received $1,850 in interest from a savings account, received $15,000 in winnings on a television game show, and contributed $2,300 to a tax-deferred savings plan. He is entitled to a personal exemption of $3,800 and a standard deduction of $5,950. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes and $1,855 in state taxes, and he also contributed $3,000 to charity. Okay, so this is his financial picture for the year, and we're going to figure out those pieces of his income. So we're going to first his gross income. So how do we figure out the gross income? We add up all of his wages. Okay, and so what are all his wages? Well, he made $46,500, okay, in wages, $1,850 from interest in a savings account. That's also considered income. Received $15,000 in winnings. That's also considered income. Okay, and that's it. So that's all the money coming in. So that's his gross income. Now, to adjust it, we're going to basically, what do? We're going to subtract off what? What are we going to subtract off? Okay, so here's his gross income, 63. So we added those three things here, 63,350. Okay, so now we're going to subtract off for his adjusted gross income. What do we subtract off? Well, we're going to subtract off what? The adjustments. What are the adjustments? In this case, he contributed $2,300 to a tax-deferred savings plan. So that's not going to be included in his gross income. So to calculate adjusted gross income, we're going to subtract that off. And so his adjusted gross income is going to be the $61,050 left over. Now, the next step is to calculate the person's, the man's taxable income. So this is where we're going to find what? We're going to find his deductions, okay, and his exemptions, and we're going to add those together and subtract it off of his adjusted gross income. And so we need to subtract the exemptions and deductions. So what are the exemptions? Well, he gets a personal exemption of $4,050, and he also gets a standard deduction of $6,300. Oh, hold on a second, something's not right. No, this is wrong. This is a typo. His personal exemption is $3,800. That should be $3,800. I don't know where they're. Yeah, I'm not sure where. Yeah, standard deduction is $5,950, and his personal exemption is $3,800. Does he have? Yeah, he's a single man. Does he have any kids? No. So he's got a personal exemption of $3,800, and then he's got a standard deduction of $59.50. Okay, so we're going to need to subtract off the exemptions and deductions. Now, in this case here, this is wrong. This is $3,800, and he has a standard deduction of $59.50, not $6,300. Now, if we look at his deductions, though, his itemized deductions, right? So his itemized deductions, what does he get to deduct? Well, he had $6,500 in mortgage insurance, right? Of interest anyway, interest on his mortgage. He had paid another $2,100 in property taxes, $1,855 in state taxes, and then he contributed $30,000 to charity. So if you add up all of these amounts, he has an itemized deduction that's a lot larger than his standard deduction of $59.50. So we're not going to take this, we're going to take this. And so now we're going to add this. Now again, this is wrong. This should be $59.50. So $59.50 plus the $1,344.55, and then we're going to subtract that. So his adjusted gross income, again, based on these numbers, again, these are not going to be correct. Yeah. Yeah. So this should be, oh, I'm sorry, this should be 3,800, not 5,950. This should be 3,800, his personal exemption. So this would be 3,800. So it's going to be about $250 less. So this would be $250 less, which means this is going to be $250 more. So this should be 43,805. No, 43, 795 is what this should be. Okay, so a little off on there. Okay, so now this amount here is his taxable income. So now based on this, we got to figure out what his tax is. Okay, what his taxes are. So this is how we figure out the taxes. So it's done by tax brackets. So what happens is he's single. So we're going to first find the column that he belongs in. So he's single, so he belongs in here. Okay. So this also includes unmarried, divorced, or legally separated would be considered single. Okay. Now, the first $92.75 is going to be taxed at a 10%. So that means for the first tax bracket here, he's going to pay, it's going to be $927.50 is going to be his taxes. Now, from $92.76 up to $37.65, that amount, whatever falls in this amount, is going to be taxed at a 15% tax bracket. Now, he doesn't get taxed twice. So what we do is we subtract this amount from his taxable income. And then whatever that net amount is, that's what's going to be taxed at the 15%. Okay? And then anything that spills over in this tax bracket is at a 25%. And then anything that spills over into this tax bracket and so on and so forth. Okay, now his taxable income was 17,000 something. So he's past this one. So the first 92.75 will be taxed at 10%. So he's going to end up paying $927.50 already. And then on the rest of it, he's going to pay 15%. Okay, so he doesn't pay 10% on the whole thing. He doesn't pay 15% on the whole thing. He pays one portion at 10% and the rest at 15%. So this is the way it looks. Okay, so here's what it looks like. Oh, hold on. So now, let's see where we're at. Oh, by the way, look at here. Here's the exemptions per person. So notice this table has 4,050, even though the problem said 3,800. Okay, so again, just be aware that some of these have typos, but realize on a quiz or an exam, the tables are going to be given to you. So 6,300. Let's see. Okay, and so that's how you would calculate his taxes, and then minus any um, um, credits, which she doesn't have any credits in this case. Okay, so let's look at this example here. So we want to calculate the income tax owed by a single woman with no dependents whose gross income adjustments, deductions, and credits are given below. And then we're going to use the marginal tax rates from the table. Okay, so here's the gross income. Here are the adjustments. Here's the tax credit. So in this case here, she has a tax credit. And then she pays this amount of money in mortgage interest, property taxes, charitable contributions, and then her medical expenses not covered by insurance. So this is her out-of-pocket that she paid for the year. Okay, so now remember, this amount has to be more than, or whatever amount of this $1,500, first of all, has to exceed 7.5% of her adjusted gross income. If it doesn't exceed 7.5%, then she cannot deduct any of it. Okay, so now step one, determine the adjusted gross income. So adjusted gross income is gross income minus adjustments. So her adjustments was 4,000. So 62,000 minus 4,000 is 58,000. So that's her adjusted gross income. Now we're going to determine the taxable income. Now remember, taxable income is adjusted gross income minus the exemptions minus deductions. And so now her exemptions from the table is 4,050 that we saw on the table, okay? Plus the deductions. Now, the standard deduction from the table is 6,300. So that's her standard deduction, and that her exemptions per person is 4,050. Okay, but she doesn't have any kids, so it's just going to be for herself. Okay, now, so her standard deduction is $6,300, but if we look at her itemized deduction, she's got $7,500 for mortgage insurance. Right there, she's already over the $6,300. Okay, but let's go on. $2,200 for property taxes, $2,400 for charitable contributions. But look at the $1,500. Now, the $1,500, her adjusted gross income is $58,000. $1,500 isn't even close to being 7.5% of her income. So because if you take 7.5% of her adjusted gross income, she would only be able to deduct anything over $4,350. And $1,500 definitely doesn't catch it, so we can cross that off. But with the rest of it, she's still a lot higher than the standard deduction. So this is what we're going to use for her deductions. Okay, so we're not going to use 6,300. We're going to use the 12,100 here. So we're going to add those together and subtract, or in other words, subtract both of them from the 5,800. And that will give you the taxable income. So her taxable income turns out to be $41,850. Now, this is where we determine her income tax. So we're going to find the tax computation. That's from the table. Okay? So, but her tax credits are $500. So we're going to subtract that from the table. Okay, now, since she's a single woman, her taxable income is $41,850, and she falls in the 25th percent tax bracket. Okay, now, does that mean she gets 25% charged on this whole thing, and she's going to end up paying 1/4 of her total taxable income to the government? No. Remember, it's in tiers. Okay, so the first $92.75 of her income is going to be 10%. And then after that, she's going to pay 15% on the next tier, which is from $92.76 to $37,650. Okay, and that's it, because she spills over to the 25th. So where she's going to pay 15% on the difference here. So from here to here, so what we do is we take this amount and subtract this amount from it. Okay, or excuse me, take this amount and subtract this amount from it. And so what do you get? Whatever that amount is, right? So that's going to be the amount of money that is at the 15% tax bracket. And then whatever left over is going to be taxed at the 25% tax bracket. And so the way we look at this is, okay, you're going to take 10% of $92.50. Then you're going to take 15% of what? The $37,650 minus the $92.75, right? Because that's the amount that spills into the 15% tax bracket. And then what you're going to do is you're going to take the 25% of the remaining mark, which is $41,850, which is her amount, minus the $37,650. Okay, and so if you calculate this out, it turns out to be this. So you get $927.50 at the 10% bracket. You're going to pay $4,256.25 at the 15% tax bracket, and then $1,050 at the 25% tax bracket. And so your total taxes for the year is $6,233.75. Okay, now we still have to subtract off the $500 for her credits. And so her taxes are going to be $5,733.75, which is what she's going to owe in taxes come April 15th. Okay, now, in addition to income tax, we are also required to pay federal government, what we call FICA taxes, which is Federal Insurance Contributions Act. This is Social Security and Medicare benefits. Okay, so regardless of how you feel about Social Security and Medicare, these are things that everyone has to pay into. And so Social Security provides payments to eligible retirees, people with health problems, eligible dependents of deceased persons, and disabled citizens. Medicare provides health care coverage mostly to Americans 65 years or older. Okay, so now here's the employees' rates. Here's the matching rate paid by the employer. And here's the rates that are if you are a self-employed individual. Okay. Okay, so now if you are not self-employed and you earn $150,000, what are going to be your FICA taxes? Well, the tax rates are 7.65% on the first $118,500. Okay, so 7.65 on the first $118,500, and then 1.45 from everything over that amount. Okay, so it'll be 7.65% of this amount, and then it's going to be 1.45% of whatever is over that amount. Okay, so in this case here, it's going to be this amount plus then this amount times the difference between these two amounts, whatever is over this amount, which is $31,500. So if we take 7.65% of $118,500 and then 1.45% of the remaining $31,500, this is what you get, and your FICA taxes are going to be $9,522. Are you excited about taxes? Anyway, you would like to have extra spending money, so you decide to work part-time at the local gym. The job pays $15 per hour and you work 20 hours per week. Your employer withholds 10% of your gross pay for federal taxes, 7.65% for FICA taxes, and 3% for state taxes. So what is your weekly gross pay? Well, that's just everything before anything is taken out of your check. So it would be $15 times 20 hours per week. Okay, so it would be $300. So that $300 is your gross weekly pay. So how much is withheld per week for federal taxes? Okay, well, you're going to withhold 10% of your gross pay for federal taxes. So that's going to be 10% of your $300, which is then going to be $30. So you pay $30 out of your check for federal taxes. And then how much is withheld for FICA taxes? Well, that's going to be 7.65%. So you're looking at about $22 and, well, how much is it? So it'd be $22.95, I believe. Okay. Okay, because you're paying $300, so it's 7.5%. So it's going to be so 3 times this amount, right? So $100, right? So $7.65 times 3, and that's going to be $22.95, I believe. And so then it says how much is withheld for, how much is withheld for state taxes? Well, that's 3%. So that's going to be $9. Okay. And then so what is your weekly net pay? Well, it's going to be your gross pay minus all 3 of these. And then what percentage of your gross pay is withheld for taxes? Well, that's going to be your, that's just going to be an easy calculation of just dividing your net pay divided by your gross pay, and then you subtract that from 100. But let's go through this. Okay. So again, here's your weekly gross pay. So it's $15 an hour at 20 hours. So that's $300. And then how much is withheld per week for federal taxes? Well, that's going to be 10% of your check, which is $300. And so that's going to be $30. How much is withheld for FICA taxes? Well, it's 7.65% of $200. Or I'm sorry, $300. That's a typo, $300. So that's going to give you your $22.95, like I said. And then how much is withheld for taxes? Well, 3% of your check, which is $300, so that's going to be $9. And so your weekly net pay is your $300 gross pay minus all your taxes. So your net check is going to be $238.05. Now, what about the percentage of your gross pay is withheld in taxes? Well, you take the total amount in taxes, which is $61.95, divide by 300, and there it is. So 20.65% of your check was given to taxes, or approximately 20.7%. Woo, excited. You get to keep less than 80% of your check. Woohoo! Anyway. Okay, well, that's the end of this section. And again, please make sure you go through this example, understand the concepts, because this is going to be a very, as far as students have a tough time with this one, but you are going to need to know this for the exam. You're going to need to know this for quizzes. So you got to make sure you understand the terminology, you got to understand the definitions. You have to understand how to calculate this stuff, because it will be on quizzes and it will be on the exam. So please make sure you ask questions in class. Do some of the examples in the textbook. Make sure you work on the suggested homework problems. And if you get stuck on any of those, guess what? Bring them to class, email me, and we'll work them out in class. We'll work out them in groups. You can ask me. Make sure you take notes and ask questions. Okay, so until then, have a great day.